Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Jeff McKee. Jeff is a real estate syndicator. He's a limited partner in 1,500 doors. He's also a general partner on 10 properties with over 2,500 doors and 200 million assets under management. And in just a minute, we're going to speak with Jeff about multifamily apartment investing. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. With that, I want to welcome my guest, Jeff. Welcome to CRE PN Radio.
Thank you, Darren. Great to be here.
Yeah, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. So longtime W-2 employee, read Rich Dad, Poor Dad, Cash Flow Quadrant, Tax-Free Wealth. 5 years ago, got into real estate to drive multiple lines of horizontal passive income. And so we invested as limited partner in several deals, apartment deals. And then we decided to go bigger, faster. So then we joined another mastermind group and started investing as co-sponsors, general partners. And then those are the 10 deals that we've closed, the 2,500 doors from Texas to Florida, basically. So I've been ramping up in this multifamily world over the last 4+ years.
Got it. And you mentioned you read all the prerequisite books. I love the Kiyosaki books there. The Cash Flow Quadrant, I think, is one of my favorites. Was that basically the impetus that made you rethink or go from W-2 to investing in real estate?
I'd say right before that, Darren, I was turning 50 years old, and my father had passed away from a heart attack at the age of 55. And I started thinking to myself, well, geez, like the W-2's been good. My wife and I, socking away the 401k. But then, we're basically relying each on one vertical income. We hadn't really driven much horizontal income from other investments, and it's all about the retirement. And then it's like, well, life is short, and what could we do to accelerate, our wealth and repeatable passive income? And that's when I started doing this research. And then like the cash flow quadrant, like you were saying, it's like I find myself as the employee, the high W-2, the high federal taxes paid, and I want to become that investor, where it's like the 0% federal taxes paid and lots of passive lines of income and reaching that financial freedom. So, I read Vivid Vision as well, and the 10-year vision, the 5-year, and then my wife and I started working on that. We hired, tax planning and strategy. We hired a company called Provision, which is actually a Tom Wheelwright wealthability company, and started going down the path of, well, hey, strategically, what are the things that we need to be doing differently? And part of that was passively investing in real estate is great. In order to get some of the W-2, write-offs against that income, you have to be more creative, sophisticated. And that's when we went down the real estate professional path, where my wife ended up quitting her W-2 job and focused on real estate, commercial real estate, as well as short-term rentals. So that was some things that we've learned along the way. We've joined masterminds, we've hired great professionals, like Provision. We've got a CPA that focuses specifically on real estate investors, because it gets kind of complicated when you're dealing with 15 or 20 K1s, and some of them you're limited partners, some of them you're a general partner, and you've got all this carried interest and different entities that we've structured, including a Wyoming holding company and things that were recommended to us. So again, we surround ourselves with some very good professionals in this space, and then teams of people to go work these investments for our investors.
Got it. Now, you mentioned kind of your education there. uh, and just how you've got going here. What are some of the benefits of real estate that you saw that really attracted you to real estate?
Initially, 5 years ago, we joined a single family mastermind group. So we did one fix and flip with a partner, and we realized that all of that income that we made on the profit and that 7 month flip was all current income. It wasn't any depreciation. And so we thought we were getting into real estate, and it turns out that we were just adding to our top line. So then I started rethinking that. We also did a buy and hold of a duplex. And we just did one of those because we started looking at the numbers and saying, I don't know that we can scale if you're getting, $100, $200 per door. And I mean, to get to the passive income number of, let's say, 20,000 a month, that's going to take a lot of single family homes. And we did one of those. So we did one fix and flip, one of those. Then we did this homestead strategy where we live in Austin, Texas, and in just south of downtown, we bought a teardown house 3.5 years ago, and we went down that path. So we built two houses on that, and that's part of the homestead strategy. Again, more single family. We live in the front house that is our homestead, and the back house is an Airbnb that my wife self manages. And so that's been a good strategy for us. But then quickly after all of that, we moved on to commercial real estate to basically to scale up the number of doors, and then also to have them in close proximity and have the equipment, the infrastructure be all part of the same versus having 10 or 20 or 50 single family rentals that have all different components, and your repair and maintenance people are going all around town trying to keep up with your rentals. And so we just felt that this commercial real estate business was mostly in one location, mostly with the similar components, a lot easier repair and maintenance. And that was just more scalable, that we found for us.
No, that's definitely some words of wisdom there. If you don't mind me asking, who is the mentor group that you are working with?
So the single family group that we joined, almost 5 years ago, they refer to themselves as the Big Dog Group, but it's Phil and Shanoa Grove, based here in Austin, but they also have chapters in Dallas and Houston. Then we joined, Brad Sumrock's group, and in terms of limited partner investor, went through all the training, invested in a bunch of deals through those groups, and then eventually we decided to become more active, and we joined Mark Kinney's Think Multifamily group, which is basically just general partners and looking for large commercial apartment buildings, mostly from Texas to Florida.
Yeah, no, all those. I'm not familiar with the big dogs, but definitely Brad and Mark Kinney's group there that definitely are noteworthy groups and do a lot of good work there. So when you made the decision to go from being more of an LP to participating on the GP, what were some of the things that appealed to you, or the considerations that you had to overcome or think through to do that?
Yeah, part of it was the tax implications of having, you or your spouse become a real estate professional means you need to be actively involved in real estate, not passively involved. And that meant that we need to move more to the general partner side on future investments. As well as, let's say, self-managing properties like the duplex that we still own. The long-term hold is really managed by third-party property management, and so you can't really count those hours towards you actively managing that. But the Airbnb, for example, is self-managed by my wife, so all of those hours count. All the hours towards real estate investing as a general partner, doing the due diligence, meeting with investors and all that, those hours count. And so it was really around working with Provision on what would it take to one of us to qualify as a real estate professional. So my wife ended up leaving her job to do that full time, and that was a large part of shifting over to the general partner side, was to have those hours count towards active investing, was a large part of our consideration.
Got it. And so you made the switch, and then you kind of overcame some of the hurdles. What, having made the switch, and now you're acting more on the general side of things. If you were to kind of convey to some of the listeners, some of the things that you've learned that would expedite their learning curve, what's like a number one thing that stands out in your mind?
Joining paid mastermind groups has certainly accelerated, our involvement in this space. It gets you more confident. It surrounds you with other like-minded people that are going down the same path. And the whole thing about a mentor or a mentoring group is just to speed up your time. And we've had enough resources that we could pay for those things. Other people may join, bigger pockets and do some of the free mastermind mentoring groups. We just felt, joining some of these paid organizations would accelerate our time to get to where we want to be faster. And so that would be my number one recommendation is to join relevant, mastermind groups that you're interested in what they're doing. And people, I mean, that's part of being a mentor versus a teacher. Like a mentor is actually doing that. They're out there buying, they're investing, and then they're coaching you on how to do it versus someone that has learned something theoretically and is trying to teach you what they've learned from a book. So we basically follow people that are doing this day in and day out.
And now that you're on the GP side, what are some things you've learned on the GP side as opposed to being passive on the LP side?
Yeah, so you're definitely closer to the brokers and what goes on the front end of the transaction. We're very close on the underwriting, and so basically going through the detailed underwriting tool. Again, each group typically has their own tool that they use and they update. Basically, it's an Excel spreadsheet usually with a series of 15 or 20 tabs, and it gets pretty detailed. So there are actually classes just on underwriting. Like we're about to go to a follow up on a deal analysis workshop that's basically a 3-day class on just the underwriting piece. And so that's always changing. Like during COVID, it changed, with the reserves, the lending, changes. And then, so we have a loan broker, we have an insurance broker, we have other people, SEC lawyer, other people that are members of the team. So you get closer as a general partner to all of those activities than a limited partner. The other thing that, we've learned along the way is, I've been able to be a key principal, like a guarantor on some of this debt. This is typically non-recourse debt. So being a general partner can also enable you to be a key principal on some or all of the debt, depending on how much there is. But then also, we're able to provide earnest money down at risk capital as a general partner on the front end of the deal. So you've got to meet certain deposit requirements from the lender. You've got to pay for the loan app fee. You have to pay for the due diligence up front. You've got to pay for some of this inspection and some of the environmental studies, and all that stuff's out of pocket from the general partner team, and they need liquid funds. And so some of us have those funds, and we can put those up at risk at the front end of the project. And then there's also the capital raising part, and so that's what I've been spending a fair amount of my time on is learning that side, and then bringing along friends and family, because I've been in the high tech, W2 world for 30 plus years. And so I have a lot of high tech friends that don't understand maybe this type of commercial real estate investing. And so that's what I've been doing is been writing blogs and newsletters and videos and trying to educate people on this type of investing. And so those are some things we've learned along the way as general partners that as a limited partner early on, we didn't really know existed and how all that worked. We were just basically listening to the finished product of the investor webinar. Hey, here's the PPM you can read through. And then here's the subscription docs, and then wire in your money, and then get the monthly updates from the GP team. So this being a co-sponsor has really opened us up to understanding what goes on the front end, and also a lot of the deals that never make it to getting funded. Right, a lot of the deals the LOI falls through, the purchase and sale agreement falls through, and so you get access and visibility to a lot of those things that happen.
Yeah, it definitely takes it from a very passive thing as an LP to a very active thing, while you're on the GP side looking for the deals to present to your investors in that. I wanted to ask you, you mentioned kind of educating some of your friends and family and the work you're doing kind of in the education realm there with blogs and videos and all that kind of stuff. What do you find that's some of the points that potential investors don't know, and also some of the benefits? What is it that really appeals to them?
Yeah, I mean, I think sometimes, the jargon in commercial real estate, for example, a cap rate, capitalization rate can, it confuse people initially on like, what does that mean? What means, basically, if you were to pay cash, what would your return be? And we typically put 70% debt on these. So we're, reasonably leveraged with typically government debt. I mean, I didn't know what that was going in. I didn't realize that Fannie Mae and Freddie Mac were subsidized by the government, and you can get below market rates because the government wants to incent investors like us to provide housing for Americans, so the government doesn't have to build all these houses. And so it's not only Freddie and Fannie being subsidized to get low cost long term debt in the United States. It's just amazing compared to what other countries have to do to get debt. But also the tax benefits that we get. I didn't really realize, if you're helping to provide housing for others, the government has all kinds of incentives for you and your money on how you're able to either use, like nowadays we have bonus depreciation. So if you do a cost segregation study and the 5 and 15 year components in an apartment complex in this example can get accelerated to year one, and you get basically a phantom loss. You get a K1 with a big negative number based upon how much you invested and how much bonus depreciation was allocated to your investment. And that could go offset, your long-term capital gains in other asset classes. And then if you take it another step further, if you happen to qualify as a real estate professional, then those losses could then offset your W-2 federal taxes paid, which is what we're able to do. Now, not everybody's able to do that. Initially, when I went through some of this training early on, it's like, oh, wait a minute. So as a limited partner, I could invest, let's just say 100K, and I'll get a negative 60K K1, and I can take that negative 60 and offset it against my W-2. It's like, no, sorry, you can't do that as a limited partner, but you're on the right track. You could offset any long-term capital gains you had that year with that, but you'd have to become a real estate professional in terms of the IRS designation to get the full benefit of offsetting your active income. And so then I've learned a lot along the way as it relates to the benefits. And like Tom Wheelwright talks about, the U.S. tax code is what, I don't know, 1,000 pages, and only like 10 pages are all the tables of what you owe and how much you owe. The other 900 plus pages, it's a series of incentives for the government to incent you to do certain things, whether that's to buy an electric car to help fund a solar or wind energy, or in this case provide housing for other Americans. There's like the 1031 exchange still exists, which is a tax deferred, kick the capital gains tax down the road. And so there's all those kinds of things that are there in the real estate world I didn't fully understand. I understood about the from a single family perspective, the homestead exemption. If you live in a house 2 of 5 years, if you're single, you get up to 250,000 of exclusion of capital gains tax, and if you're married, it's up to 500,000. For that, I knew that part, but I didn't know all this commercial real estate. I didn't know about bonus depreciation, which this year's still 100%. Next year it drops down to 80%. But all those kinds of things I learned along the way, and so that part's been fascinating.
No, I was to say the learning, and I'm kind of curious as you start to attract investors and appeal to just anybody you're raising capital from. Do you find that the depreciation is something they're completely? I mean, it's a word they know, but how it applies to their situation, is that a familiar thing, or is that like a, oh my gosh, kind of under, what's their reaction when they come to understand that?
It's mostly an oh my gosh moment. It's like, okay, wait a minute, walk through some example, for me, like just to help me run through, and just, knowing that most of the people I talk to are W-2 employees, I explain what benefit they can get. And then if they ever become a real estate professional, what benefit you would get from that. Like if your spouse, as an example, became a real estate, professional, or vice versa, and so I walk through those scenarios too. But yeah, mostly it's eye-opening. The other one that I didn't realize 5 years ago, and that I talked to a lot of W-2 employees about, is that you can use a former IRA, towards real estate investing, but you have to change the vehicle that you're in. Like I've been trained to max out, the 401k. It's all about stocks, bonds, mutual funds. And there's this whole world of alternative real estate investing, which they consider commercial real estate and alternative investing. Like I didn't know that you could do this kind of stuff as an individual. And then, of course, Fidelity and all the big brokerages don't really want you to know that because they want you to invest in the real estate investment trust that they offer. They don't want you to do private placement investments that you can do as an individual, like, in the SEC. These are governed by the SEC as well, but these are separate from, let's say, Wall Street. These are Main Street investments. And so I had worked at Compaq Computer Corporation in Houston for 12 years. I had an old IRA. And then through my education, I originally moved that to a self-directed IRA with a company here in Texas called Quest. And then I had heard about this UBIT tax, this unrelated business income tax, that if you invest in a asset that uses debt, even though it's in your self-directed IRA, the government can tax you on the gain of that. And it's not a pretty situation. Or if you move an investment and if you open up a solo 401k, also there's another EQRP thing. But if you have a solo 401k, that is not subject to this UBIT tax. So that's what I ended up doing, is moving my limited partner real estate investments into a solo 401k. And as those deals go full cycle and they sell, now I'm not subject to the special UBIT tax. I'm able to keep all of that in there tax deferred and keep investing in more and more deals. And so that's another area that a lot of W-2 people don't know about, that you can take an old IRA and move that over to a solo 401k and invest in real estate, and you're the custodian of your account, et cetera. And so that's open, and that frees up a lot of capital for people. Now, of course, when I contacted Fidelity to roll that money over, they go, you can't invest in real estate assets with that money. It's like, oh yeah, you can. So I just had them cash out, the stocks, bonds, mutual funds. You settle it to cash. You do a straight transfer to the other account. You make sure it never comes into your name personally. It gets transferred, in my case, to a solo 401k in my name, and then you manage it. You're the managing member type of a thing. You're the custodian of that account, and then you invest, in it, as long as it's not a deal that you're personally involved in. So when it's a retirement account like that I'm in control of, there's certain prohibited transactions. One of them is I can't invest in my own deal that I'm a general partner. So I invest in other people's deals with those monies. There's certain rules that you have to follow.
Yeah, no, I got to tell you, the as many times as I've talked to people about these things, and I love the fact that there's a continuum of knowledge and the opportunity to continue to learn. The fact that you just mentioned that the solo 401k allows me to invest in other deals that have debt, because I had somehow in my head limited that to more like lending was kind of the ideal thing. If you made private private loans, maybe for a flip or whatever. But again, if it was outside of you or your whatever, forget it, your ascendants and descendants, you can't do it to your kids or to your parents, but you could do it to like a nephew or anybody that's not directly related to you, up or down. That you could then, interest was like one of the best or the cleanest, I guess, ways to go in and out. But I hadn't realized that the solo one gave you that the UBIT free investment thing there. So
Yeah.
I
Yep, yep,
appreciate
yep.
you
Solo
sharing that.
401k is not subject to any unrelated business income tax that the self-directed IRA is subject to for any product that uses debt. Now, if someone is doing fix and flip and they're a private lender, being in a self-directed IRA is totally fine. The key though is that you need to fund 100% of it. You don't want to mix it with debt or anything.
Right.
And so like I did that. Like I had the solo 401k. There was a a gentleman in Dallas that I knew from this big dog network. He wanted help buying and doing the rehab. So my self-directed IRA funded all of it. There was no other debt involved, and I was the single lender, and that was fine. You make 2 points, and then it's a 10% interest rate, and all that kind of good stuff. But it's a reasonable amount of work to go do all the documentation and to do all that. But that is perfectly fine when there's no debt involved. You're the lender using your funds, and you're not related to that person. You don't have an interest in that property, all that stuff. That scenario is perfectly fine. It's when you want to invest as a limited partner, as an example, in like say a apartment investment syndication, you can use a solo 401k and not be subject to UBIT. The other thing I did is I invested in a hard money fund here in Austin that funds other people, and they provide good returns to me as an investor, but they also use debt. So I had to move that investment from a self-directed IRA to my solo 401k. So whenever I would go full cycle and sell any of that, that wouldn't be subject to UBIT. But I had to ask that company, do you guys use debt? And they go, yeah, we do. And so part of they use equity from us, and then they use debt from other people. And so that part that is leveraged would be subject to tax on the gain if I had left it in my self-directed IRA.
Right. No, just a subtle difference. I mean, somebody hears, IRA solo, but the solo 401k is the one that gives you that option, if I understood what you just said.
That's right. That's right.
Okay.
And then there's some providers on a solo 401k that people can research, and they'll want you to set up an LLC, which is fine. You can do that. There's just an expense. And then there's other providers that don't have you go through that. They have different things they follow. But there's multiple providers out there for a solo 401k. And so I would encourage people to do their own due diligence. Obviously, consult with your CPA, your tax provider, right, on your situation, and maybe your financial advisor. But yeah, definitely get some professionals around you, and not just don't listen to me.
No. But I appreciate you making that clear, because, like I said, I hear people, and sometimes there's such a blur of terms and stuff, and you think you understand, and what I think also is somewhat confusing is the difference between an IRA versus a 401k. And you go solo. I get everybody gets the concept of taking it out of your employer sponsored plan, but the options beyond there, that's good.
Yeah.
So how has the capital raising gone? Have you I mean, sounds like you're in a lot of doors. What's been the response from
Yeah, no, it's
people you
been good.
approach?
Another book that I read, in the last year was Who Not How. And so and I also read, Tim Ferriss's 4 Hour Work Week. So I basically hired a virtual assistant in the Philippines to help me with social media and strategize and execute on some of the capital raising stuff. So I've tried to expand. I've hired a part-time writer. So I've actually put out some blogs and things around this tax situation, and trying to educate my investors on these kind of topics. And so part of that, and then basically getting mentoring and advice on capital raising. As well as following some of our SEC lawyers and their advice in this area, because right now the 10 deals we've done have been the Reg D 506B as a boy, and then that allows us to do up to 35 non-accredited investors that are sophisticated, that are familiar with this, and an unlimited number of accredited investors. But when you do the 506B, you cannot advertise, so you have to have a substantial relationship with these investors. So I basically have one-on-one calls to understand people's situation, and to talk through these types of investing. And so that's part of the 506B. There's the other exception. You could do a 506C, as in Charlie, and that's for accredited only. And you can advertise, you can post your deals, you can look for brand new investors that you haven't met before. We don't do that kind of capital raising, that regulation at this point. We could in the future, but yeah. So part of my situation is I have one-on-one calls with all potential investors, and then obviously follow-up calls with them too when they have questions on deals.
Yeah. So how many, you said 10 deals you've done here in the last 4 years, is that right?
Right.
And you've raised money for each one of those?
Correct. Yes.
No, it's great. I would think that, the first one, I've never raised capital myself. We've done all of our um, investments, just, my wife and I, but what I recognize is really the limitations based on the lack of capital. It's really a matter of, raising capital in order to really get into some bigger deals and have some more, measure of safety in some of those larger deals based on, what the larger properties can afford based on, in-house management and staff and all that kind of thing. Are you actively involved in the operation management then, or do you get involved in the asset management?
Typically, we will hire as part of our team a full-time asset manager that manages the full-time third-party property manager. So I personally will join some of the asset management calls once we own the asset, but we have someone on the team that day in and day out, they're managing the property with the third-party property manager. These properties are so large and they all use basically agency debt, and the agencies require us to use third-party property management. They don't really want investors self-managing their property, which is totally
Right.
fine. And we don't really want to self-manage these either. And so then we have people on our team that are either former property management people or former construction people. They're our designated asset manager as part of our general partner team. And then they manage the third-party property management. And then the other co-GPs like me will join the asset management calls just to make sure we're staying on track.
Got it. And do you have any deals on your plate right now that you're working on to close, or
I do, but I can't talk about them.
oh,
Yeah.
right.
Yeah,
Yeah.
yeah. But I
So
do. Yeah. So we have two deals that are under contract that are in the works. People that are part of my investor database are seeing those in the webinars and the decks and all that kind of good stuff. But yeah. So that's the thing. Like getting back to the capital raising. One of the things I noticed about our group is we have great deal flow. We're able to get on market, off market deals under contract. The critical success factor is having more capital involving others, other outside investments on the large deals. Like when we're purchasing apartments that are 40, 50, 60 million dollars, we're raising 10, 12, 20 million dollars. And sometimes we're using private equity for a part of that investment, and most of the time we're using the private equity that we're raising from friends and family, and we're just trying to expand the friends and family, so we're not relying on any private equity groups to cut a big check. And so that's just one of my personal goals, is to help bring more people along, to show them this path to financial freedom, to give them the opportunities to invest in these deals. Like, I mean, who would think that you would get internal rates of return that average between like 15 and 18%, like on real assets, an annual percent like that. I was just used to 5 to 8% stocks, bonds, mutual funds, and after all the asset fees, from the companies and your advisors and all that stuff, there's a little bit left for the investor. But when you get to this private world of investing in real estate like this, the returns are just amazing. And then we're in a little bit of an abnormal cycle right now, where our deals are starting to sell faster than we had planned. We had planned for 5 to 6 year holds, and now some of these deals are selling in 18 to 36 months from when we own it, which is great, for the investors. And we typically will just sell and then, give people the opportunity to invest in the next deal. They can do a 1031 exchange, which means they could roll those funds into that next apartment investment. They could do a 1031 and, get out of the deal once we sell it, and they could roll it into something else that they want. But that's, again, another tax advantage and strategy that the government allows us to use, is just to keep deferring this long-term capital gains tax when it's more than 12 months.
yeah, no, I was going to ask you the hold time. That's sweet that you're able to get them, up to where you were intending in just a couple of years. That makes for some happy investors. Do you find most of your investors ready to sign up for the next deal?
Yeah. I'd say most of them sign up for the next deal because they go, well, geez, I had planned this money to be out 5 to 6 years. Now you're telling me you've doubled my money in 18 months. That's good news. Now I just need to find a place to put it. And now what we're starting to do is to say, well, here's the next deal. If you're interested, here are the numbers. We can roll you straight into that deal with all of your gains rolled in. Or, we can do a 1031 and give you the money, and then you have to identify and work with an intermediary and make sure you follow all the rules. Or you can just take the money out and you can pay your 20% capital gains, and you can choose, maybe you need that money for something other than a real estate investment at this point in your life, and maybe you'll just do something else with that. So we just give people the option. But it's this whole thing about velocity of money, and that's what you're looking for is, hey, I want that velocity of money, and then I want to be in control as an investor. Do I want to reinvest in another multifamily deal with this group? They did really well. Do I want to go take that money and invest maybe in a short-term rental, or maybe I want to do mobile home parks or self-storage, or maybe I want to take it out and I'm going to go, pay for a wedding or a big trip or college education, and I want to take that profit and I'm willing to pay the 20% tax, capital gains, and then it's free for me to do with it what I want. And so we just want to give investors options, but we do want to try and provide that high velocity of money. At the same time, we want to be conservative when we do the underwriting and say, hey, it looks like it's an 18% internal rate of return with a 6-year hold, so just plan on your money being out 6 years. If we have an opportunity to sell sooner, we will.
Yeah. Yeah. No, I was going to say the bird in the hand's worth two in the bush. And if you can get it faster, I'm sure that most investors appreciate that. And again, even though it creates new challenges on what to do with it, just to recognize it and to move on. It's contrary to what I've always thought. I mean, I've been doing this long enough that I always thought, kind of invest, buy and hold. That was kind of my mindset. I just didn't realize, like you said, the velocity of money is really where you can create the substantial gains. But
Yeah, yeah. Well, here's another difference too that I've learned over the years, Darren. Like when you think of residential, you think of comparables. How is the property valued? It's valued based upon the comparables in the area that are similar to that's sold, and that's just the price per square foot. So everybody understands that. Okay, that's fine in appraisal. Well, when you get in the commercial world, there's this whole thing called the net operating income. It's like, okay, what's the net operating income? Okay, it's your revenue minus expenses. Well, in the commercial world, let's just say it's a 100-unit apartment complex in San Antonio, Texas. When an appraiser comes in, they don't look for other 100-unit apartment complexes and look at the property tax roll and say, oh, it's worth, $10 million. They look and say, well, give me the numbers. Like, show me your books, show me your profit and loss, show me your trailing 12 of your financials, and I'm going to tell you how much we're going to value this property at. That then some lender will give you a loan, let's say up to 70% of the value of that, and they look at that. And so then, as an owner operator, as a syndicator, we're able to force appreciation by improving the outside, but also the inside of the units, and increasing rents over time while holding expenses, let's say, relative at a lower growth than your rent increases. And that spread, that gap, adds to your monthly profit, which is the net operating income, which is before your debt service. That's what we're able to do. Is there's also, a concept called loss to lease. So in this kind of COVID world, let's say maybe almost post-COVID world, we're coming out of a time where there have been a lot of concessions on rents, where people were able to stay in these properties without paying rent, but also to keep the occupancy at a reasonably high level. To get people to renew, we might have offered, get the 13th month free, or we're going to, reduce your rent by $100 a month. Well, now the rents are going the other direction. They're starting to go up, but oftentimes the rent of this particular apartment community that we're looking at buying, they haven't increased rents to market rent. The difference between their in-place rents and what the market will bear for that area, that's the gap. That's the loss to lease that we plan on matching over time. As those leases expire, we go, let's just say it's a 1-bedroom going from $600 a month to $800 a month. The new rents in that market, let's say, are $800 a month. When that lease is coming due, we let the tenant know, hey, instead of renewing at $600, it's now going to be $800 a month. You have the option to renew, or you can go somewhere else. And then there's other people in line that are willing to pay the $800 a month in this example. And that's where you're able to, what you would call force appreciation. Now, there's also the classic units and the modern units, the rehab units, if you will. Well, we put money, sometimes $2,000 to $10,000 per unit, per door to improve the inside. And that's what really justifies a lot of the market rent increases we're able to charge. If someone walks into, oh, these are new countertops, refinished cabinets, new flooring, all new appliances, LED lighting, low flow toilets, that save money. All these things that we're doing on these units then command higher rents than the classic units that maybe they were in. And so that's what we were able to learn. And just a small increase in that net operating income makes a huge difference to the value when you're dividing it by the capitalization rate of a 5%, or a 6 cap. That increase it's amazing what it can do to the value of your apartment community when you're able to manage and increase the NOI.
Right. Well, and then as a measure of the percentage that you're into the property, it's the exponential return there. It's a
Yeah,
beautiful thing
exactly.
there. So no, I appreciate you going through that. Hey, Jeff, if we could, I'd like to shift gears here for a second. Um, by day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's a couple of strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, then we look to see if there's a way we can minimize the risk. And when avoid nor minimize are options, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And I like to ask my guest if they can look at their own situation and frame the question, what is the biggest risk? And provide an answer. And you can look at it from any one of a number of different things. Could be interest rates, could be the political environment, could be taxes, it could be weather, it could be the market, however you choose to frame the question. If you're willing, I'd like to ask you, Jeff McKee, what is the biggest risk?
Yeah. I mean, I would say, from a property casualty, some of the areas that we invest in are on the Gulf Coast, whether we're invested in Corpus Christi, Jacksonville, Florida, all these places. And so, we do review and have great insurance on our properties. And so it's in case there's, fire, flood, that kind of a damage, which, it happens occasionally in these communities. And then you also need the business continuity insurance in terms of if we displace guests maybe to a hotel or another community while their unit is getting repaired, maybe there was a flood or there was fire. We also need the business continuity to make sure any rents that we would have lost that were covered on that. So yeah, we're basically well insured, and so that's something that we're very cognizant of in terms of where are we with the FEMA flood map, where are we with this, and in terms of any hazards that we've got on the property. So that's probably the first one. And then lately, in a rising interest rate, the second area of risk we're trying to mitigate is trying to put rate locks. So trying to lock in the rate before it keeps creeping up on us. And so then that would be another one. Basically, we're fortunate in the U.S. to have a lot of fixed rate long-term debt. So we're just very careful of the adjustable rate mortgages, the ARM products out there, because they could creep up over time. And so when we're putting a lot of debt on these properties, 30, 40, $50 million loan, we're trying to look at the rate lock and be able to manage that. And sometimes, we pay a bit extra to get that type of insurance, the rate lock cap. So we try and put a cap on any interest rate that we're locking in long-term debt. And so those would be two areas, kind of the property casualty and business continuity. And then the second area in rising interest rates, having a rate cap and paying for a lock and underwriting that expense to give you some assurances of your debt payment won't escalate much over time.
Yeah, no, definitely some areas of risk, and anything you can do to mitigate that is going to help your investment perform that much better. Jeff, where can the listeners go if they'd like to learn more or connect with you?
Yeah, you bet, Darren. They can go to the McKeeCapitalGroup.com. So just McKeeCapitalGroup.com. And then my email is Jeff at McKee Capital Group. And on the website, you'll see the 10 closed deals plus some of my LP investments in the portfolio section. You'll see a resources section with a bunch of blogs. Again, some of the topics we just talked about. But I also have a download of a best-selling book I was in last year. It's Bringing Value, Solving Problems, and Leaving a Legacy. And that was part of another mastermind I'm part of, this Kyle Wilson mastermind. But in that, I wrote a chapter about scaling from single family investing to multifamily investing and what I learned along the way. And then that PDF is a free download. And I've got a short video about multifamily real estate investing for a lot of people that are just getting familiar with it. So it's an intro video on exactly what we've been talking about.
Awesome. Jeff, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Well, thank you so much for hosting, Darren. I appreciate your time.
You bet. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.